Good morning, everybody, and thank you for joining this Accountant Online Business Growth webinar. My name is Rose Kervick, and I'm a director with Accountant Online, and I'm joined this morning by Sean Wallace, who's founder of Wallace Corporate Counsel here in Dublin. And Sean is going to talk to us about various share option plans. And how, what the tax implications are, the different share classes, and the best practices and criteria for setting up an employee share option plan. So if you have questions while Sean is presenting, please do drop them into the chat or the Q&A, and I'll moderate those questions, and we'll put them to Sean at various stages throughout the presentation. And then we are recording this morning, so we will send on the recording to those who registered for the webinar and anybody who's also attended, and along with Sean's details. So Sean, you're very welcome. Thank you very much for giving us your time this morning.
Thanks, Rose. Morning, everybody. My name's Sean Wallace. I'm a partner in Wallace Corporate Counsel. We're a corporate law firm based in Dublin, although we have clients nationwide. We specialise in corporate transactions, namely the sale and purchase of businesses, investment transactions, and we also provide advisory services in relation to things like ESOPs, which is or employee equity incentivization, the subject of today's talk. We predominantly work with technology companies. That's probably a 70-30 mix in our client base, and that seems to be an indication of where the market is nationwide. We do a lot of seed investments, Enterprise Island investments, early stage venture capital funding, etc., which may be of interest to some of the audience there in terms of the profile of clients that Accountant Online work with. We work with hundreds of early stage startup companies and trying to guide them through funding cycles and issues that come up along the way and helping them to avoid mistakes. And we've worked with Rose and her team at Accountant Online for a number of years now. So we're delighted to talk about employee equity incentivization. And I thought, just given the profile of the audience, we might just take a slightly broad brush approach in part one of this and just address some of the key questions that typically arise for early stage and startup companies when they're looking at employee incentivization, and so maybe spend 10-15 minutes on that and break for a session or a Q&A and address the kind of higher level questions, and then we can kind of look at some plan structuring kind of issues and the various types of plans, what are the implications of them, and how you set those up effectively, and then we can follow that up with a second Q&A. So trying to keep it fairly generic approach at the start. The key questions to my mind, and the ones we're most frequently asked, are why, when, who, how much, and how. So let me run through each of those. Firstly, the why. Why are companies interested in providing equity or offering equity to employees? And there's a number of valid reasons for this. The first is it's a really effective recruitment tool, and particularly in the technology sector, but also, it's becoming more commonplace across other industries. This is seen as almost a must-have for employees looking to join a startup or an early stage company. So it's an effective recruitment tool and something to have in the locker. Bearing in mind, and to the next point, the cost efficiency, a lot of startups or growth companies don't have a lot of cash to pay high salaries to attract the talent they need. So options for or equity provide an alternative means of rewarding staff or employees and recruiting them in a cost efficient manner. So a lower salary can be offset by employee options or equity, and that has a saving for the company as well. You're avoiding a 10% plus PRSI charge on the granted shares or options as opposed to an increased salary. So there's some real tangible financial benefits in that as well. The next reason is around retention. Employee equity incentivization is an ongoing process. It's not just an initial award and let things go from there. It really can be used as a retention tool. It says, well, look, I can make progressive awards. If somebody's starting, they get a small award, and then annually those awards can be increased. Also the way, and we'll get into the way options or shares can vest, but it's really a promise effectively over a period of time that the longer you stay, the more value you will grow in these options or shares. And that helps with retention and keeping staff aligned with where the business is going and helping them focus on, helping you drive your business forward. The incentivization aspect obviously is what is at the end of this. And while there's at the end of this process for most companies, you're looking at an exit whereby the options will be rewarded. Now, that won't be the case for all companies, but for the majority of employee share ownership plans, that's the ultimate goal, that everybody is rewarded on the ultimate sale of the company. There are other plans that you can put in place where employees are rewarded for long service and things like that, or we can. There are features that allow departing employees to get value, but typically it's an exit reward. And sorry, I've skipped over probably one of the more important features that really gets underestimated, which is a sense of ownership in a business. And there's lots of studies out there that show that employee productivity is often driven by a sense of ownership or a greater pride in the work where they share in the ultimate benefit. So I think that's often underestimated, and you certainly see it in a lot of early stage and growth companies where if there is a real sense of ownership, that helps drive the business forward, and is often overlooked in favor of more financial rewards. But I think that's a real tangible benefit. So that's a bit about the why. Let's have a look about the when. So a very common question we get asked is, when do we implement this? When is too early or when is too late? And there's no firm or fixed rules. Companies will go through a life cycle of investment, or if you're lucky enough, you may be self-funding. But typically you'll look at this very early on in the process, and that'll be driven by financial considerations, such as your ability to attract staff with high salaries or not. And most companies will look at this fairly early on in the process, certainly within the first 12 to 18 months of establishment. And that's it's important that it's looked at early because, I suppose there's two aspects. You may be rewarding the initial team, so the very early kind of founder team or management team, and there are better ways to reward them earlier on in the cycle of a life cycle of a company than there are later. And the rule of thumb generally is the later you leave this, the more difficult it is to make it both tax and financially efficient for employees. But we can get to some of the taxation considerations around that. So early is good, but you've got to balance that against the cost implications of doing this and the management time and putting in a process or a plan of this nature. So
Sean, when you say early in the process, you mean like kind of first 18 months?
I'd be looking at the first 12 to 18 months. It's an important tool in the why as to recruitment, retention, etc. And look, there'll be an expectation from employees generally that some form of equity is on the table here, and it gives you an advantage over companies that are not offering. So look at it early, I would think.
And Sean, you mentioned studies show a sense of ownership being very important, which makes sense. Do you know of any studies, or would you see any difference in terms of the perhaps equity versus profit share, or I suppose in these types of early stage businesses, there's less opportunity for profit share because there's probably no profit for quite a while. But do you see any difference in that? Easier to do profit share, or
a big difference? It's virtually impossible for most startups or growth companies to do a profit share because there aren't any profits. They'll be loss making for a good number of years, particularly those that require third-party investment. So the profit share element isn't really a feature, and this is probably the optimum way of rewarding employees. I mean, obviously there are bonus plans and commission plans and things like that, but again, very tax ineffective, and you're paying the higher marginal rates of tax on that. So
makes sense. Yeah.
So the equity piece of this is probably more important than those features, as well as the ownership issue.
Yeah.
Back to the when. I think it's important to consider if you have a plan in place, when do you reward your employees? Hopefully most businesses will have a probation system whereby employees will serve a 3 to 6 month period of probation. If you don't, you should consider that. Given the nature of Irish employment law, very, very difficult to move on employees that aren't working out. So I would look at share or option awards post probation. So I wouldn't be rushing, even if I had a very key hire, I'd say, well, look, subject to you satisfying the probation period, the equity award will kick in at that point in time. So that's an important consideration. The nature of the award as well is this something that I want to vest over a number of years? Typically options and shares will vest as to value over a 3 to 4 year period. Longer than that is really off market, and you want that period to commence post probation, or and then to continue on for 3 to 4 years. Typically you'll have a 12-month period where of service whereby no options or shares will vest as to value until 12 months have been served, and then they will typically vest over the following 24 or 36 months. So the longer somebody stays in the business, the more value they grow in their shares or options, and that's I suppose the incentivization process. So people aren't incentivized to leave early. And typically leavers get nothing. So there may be provision for a leaver who has vested shares, so perhaps someone who's 2 years into that 4-year cycle, to get some value or to retain the options or shares. And we'll get to some of the detail of that. But the difficulty with that is you don't want former employees holding options or shares in a business they're no longer involved in, and that's from a control perspective, an administration perspective. But fundamentally, when a company is being sold, private companies require 100% of the shareholders and option holders to sell. And unless you've got control of that basket or pool of shareholders and option holders, then the sale process can be difficult or can be scuppered. So typically anybody who leaves doesn't get value, or there are arrangements put in place that their shares are held on their behalf and they get an economic benefit going forward. So I think that control element is important as well. There's the attractiveness of the award going in, but also you need to caveat the downside when people leave to make sure that ultimately nothing impacts on an ultimate exit. And then finally, in terms of the when, we're looking at timing and taxation considerations. Unfortunately, and I'm not a tax expert, but I know enough around options and shares to advise here. But the the taxation aspects of when you do this are important, because as a company grows, the taxation implications grow with it. So it's very difficult to reward later employees with shares, for example, versus options, because there's a negative tax impact immediately on the issue of those shares. And I'll come to that in the next slide. So the who question is, who gets to receive the awards here, the options or the shares. Now, typically you're looking at key employees, and at an early stage, you're looking at your key hires here. Who are the people who are going to help drive the business forward? And then as you move on past that 12, 18 month period, you're looking at, well, how do I reward employees generally? And you can adopt the same plan that does both. You just have a higher reward for key employees than employees generally. But some, for example, revenue approved plans, we'll come to those, require you to enable all employees to participate, and you mightn't think that's the best thing for the business. Generally, we see, for example, in early stage or growth technology businesses, because of the recruitment and incentivization angles to this, everybody generally gets to participate, whether at a very low level or increasing levels, depending on your seniority in the organization. But again, that's very much tailored from business to business, and there's no prescriptive rules around who participates and until we get to some of the more specific types of plan, which have specific rules around that. And we'll get to that in the second part. Often you'll want to reward external parties, for example, consultants or perhaps contractors you're working with, non-executive directors or advisors. A lot of firms will have an advisory board, which isn't the equivalent of their board of directors, but is a team of people that help them and guide them along the way. So options and shares are a very effective way of incentivizing those type of people who don't want to be on payroll, but they'd like to have a slice of equity, so that if the business does really, really well, they'll be rewarded for their time input. So it's a useful tool in that sense as well. And then finally, on the who side, we often encounter jurisdictional issues, and that's increasingly the case even for early stage and growth companies, where particularly over the last 12 to 18 months, people are working on online in different jurisdictions. That's going to complicate things like tax residency, etc. So we can be very, very prescriptive around how Irish employees who are Irish tax resident get rewarded, but it's slightly more difficult where you've got employees in other jurisdictions. It's not to say it's impossible, but for example, if you have an Irish employee share option plan, it doesn't generally work for US employees. They have a different tax treatment in the US. Or, for example, Australian employees also have a different tax treatment. So there's no one size fits all for employees, globally, and it's very much jurisdiction by jurisdiction. But what I would say is I would tend to implement the plan focused on the Irish employees, and then pick off overseas employees as you need to, and help them with the tax advice. It's typically tax implications only that are relevant here. And sometimes you'll see sub plans if you have a cohort of employees in the UK or in the US. So it can all be managed, and it's doable. And if that doesn't work, you come up with some kind of phantom equity plan, which really just tracks the performance of the shares or the options over a period of time, but is generally just seen as a bonus. The same
for tax purposes, it's seen as a bonus.
Exactly.
Okay. So it's like mirroring
the equity.
The equity, but it's not equity. Okay.
Yeah, and we tend to use that for employees in jurisdictions where some jurisdictions where they haven't really got the taxation of employee options or shares. It hasn't been a priority in certain jurisdictions, so not quite as established as it may be in Ireland. And in fact, Ireland is well behind the likes of the UK in terms of, the tax regimes around employee incentivization.
Okay, that's a pity, isn't it? Do you see any change in that going to happen, Sean, do you think? Or
yeah, there's various industry groups that are lobbying for greater tax effectiveness.
Scale Ireland, I suppose that's what they're really
exactly
lobbying very well for. Yeah.
And the government has listened with the introduction of the KEEP program that we'll get to in a bit, which is is getting greater tax efficiency into that into this employee share option plan. It's not quite there yet.
It seems to be designed for very big companies, doesn't it? Would that be correct?
Yeah, it doesn't quite work for companies that have a really high growth trajectory.
Okay.
That's part of the problem. And there's some quite specific limitations. So while the government is quite happy to reward people, not too much. But we can dive into the detail in the second part, Rosa, if that's okay.
Sure.
So the how much question is a very topical one. So we often have founders and management teams asking us, well, look, what is the right allocation we should make across the team? And that's driven by two considerations, really. From a founder or existing shareholder perspective, how much equity do I want to give up? And that's often a very personal question. And obviously you want to retain control, but in the life cycle of most companies that take on third-party investments, your initial 100% will dilute 20% on each financing round generally. And you've got to factor in how much of the equity pool you need to assign for employees to really drive this forward over the next, it's a 3 to 4 year program, possibly longer. So there are those kind of founder considerations, how much control and equity am I prepared to cede here? And then when you're taking on third-party investors, they'll have their own considerations here, which is like, we need this company to attract the best talent to drive it forward so that we can get a return on our investment. So in order to do that, we need to see quite a significant pool of options or shares available to attract that talent. So they approach it from a slightly different mentality. And investors will also say, but we're not diluting for that. So it's always pushed back. It's always pushed back on the founders at an early stage, or certainly at the first time you put in place an ESOP, investors will say, that's for your account, not for ours. So for example, for example, if a company, if an investor says, we're investing X thousand or million euro for 20% of the company, but we need to have a 10% share option pool, then your dilution for the founders is actually 30% off the bat. So your 100 just went to 70, even though you've only taken on 20% of investment. So things like that need to be factored into your decisions around allocation of the pool size. Typically, we see between 8 to 15%, probably 12 to 15% for tech companies, 8 to 10 for non-tech. But it's very much dependent on the stage you're at and the evolution of the company. And you may need to top that up along the way. And if there's a top up for the pool required, then investors will share the pain of that along the way, but just not at the start. So it's an evolving process as well. So, but typically those are the ranges we usually see. But look, rule of thumb, 10%. Have that in mind, I would think.
And I'm sure you'll get to this, Sean. But for that, like between 8 and 15% share options, like keeping those available for employees, then is that, you know, do you look to the future? What if you use it all up, is what I'm saying. And would you?
Yeah, good question. I would tend to look at this as a 3 to 4 year program.
Okay.
And say, well, look, if I've got 10% allocated, then let's use the first 5 now and keep the powder dry on the second 5. And that will enable you to keep it in reserve both for new hires, but also for existing staff to keep the awards rolling. So, you know, in terms of perhaps annual bonuses, so options instead of bonuses and things like that. So, you know, if you look at that over that 3 to 4 year period, then, you know, always keep some in reserve, because, you know, you just might need it for that really talented person that you want to bring into the business. And I suppose that goes to the next point, which is around, you know, C-suite, which is kind of CEO, CFO, CTO, or key staff. What sort of allocation should I expect to allow for them? So, for example, you know, if I need to bring in a really good CFO into a business, I'd be thinking, you know, this is probably a 2 to 3% higher.
Okay.
And factoring that in, you know, a CEO might be 3 to 5%, and downwards from there. So those are the kind of ballpark figures. Now, obviously, it's different from business to business and person to person, but those are the kind of parameters we're seeing. And below that, you know, it's very much how do I reward people in the hierarchy of my business, and what value or importance do I place on them? And you go from there, and it could be, you know, 0.1%, 0.5%. There's a full range there. What I would say on that is these can be fairly emotive issues amongst employees. So keep the detail of these very closely held within your business. It's even worse than kind of comparing salaries with the employee who's at, you know, in the office next door, or at the desk next door, because, you know, these tend to put a greater kind of disparity, if you like, on the value being placed on an employee within an organization. So I've seen that particular apple cart be upset many times when the information comes out. So just be
But careful. Is it not available to everybody anyway? Is it not?
No.
That information is just hidden?
No, it should be personal. I would treat it very much like a salary. This is a personal award.
But would they not appear on the share register in any case with that amount?
No, it depends on whether it's shares versus options, and we'll get to that. But typically, we're talking about options, and they never feature on the share register, because and we'll get into the difference between them both. But there are ways of keeping this private, and it should be kept private for a number of reasons. But the staff disparity issue can cause problems.
Understood.
Okay. And then the last point is really valuation considerations. If I'm valuing my business at $500,000, then, you know, 10% is 50 grand. That may not move the dial sufficiently for employees. Whereas exactly. But if my business is valued at 10 million, then 10% is 1 million. That's a big pool to be able to allocate in value terms. So that helps sometimes answer the question, how much. And employees will want to know, well, what's my option, or what's my share worth? And that's probably a more difficult question. You know, there are certain valuation points in a company's life cycle where they take on investment at a particular valuation, and you know, that information can be shared with employees so that they have a kind of a progression point. And for example, if you took in your first round of funding at a $1 million valuation, and people had options then, and then you took your next round of funding at a 5 million valuation, then, you know, they know they've got 5 times or 5x in value from their options. So I think that's really useful for employees to see that kind of valuation growth, so they know, not only am I getting my salary here, but I'm getting an increase or an uplift the longer I stay here on the value of my options.
It'd be kind of tricky with private companies, though, must be.
It is, because that's really the only valuation point is investment along the way. Now, there are a multitude of ways of valuing private companies as well.
Yeah.
And sometimes there'll be a valuation exercise required in relation to, for example, the KEEP scheme requires a valuation exercise to be undertaken. So employees will have visibility on that.
Okay, great.
Okay, and then finally, the how. There's a few structuring issues around this, and we can get into the detail later. But firstly, if you've got a number of companies in your group, if there's a trading company, a holding company, this is a question we often get asked. I would say, look, the investment funds will always go to the holding company, and companies are, 9 times out of 10 sold at the holding company level. So your employee equity should always be at the holding company level. That'll be the first one. The shares versus options, as we said, look, and what is an option, I guess, is the obvious. An option is a future right to acquire a share. Okay, and whether you give shares or options depends really on the stage of the company. It is the earlier, at an early stage, it's very easy to give shares. But as valuation grows, let me explain the difficulty here. If I award you shares worth €10,000, then you have an immediate income tax bill for the value of those shares, because it's a part of your compensation package. But if I give you options worth €10,000, you have no income tax bill. Okay. But when the company is sold, your shares will attract a CGT rate of 33%, but your options, when you exercise them at the point of sale, having paid no tax at the front, will attract an income tax rate, and probably at 52%. So there's a real, there's a delta there. So if you're thinking of rewarding employees early, then use shares, and as you get later and later, options really become your only tool. And then we've discussed the control issues around, making sure that you keep everything within the control of the company at all times. And, sometimes we use nominee structures whereby, shares are held within a nominee company on behalf of the employee, or options when exercised are held by that nominee company. All that effectively means is that there are no votes attached to those shares. And they're within the control of the company at all times, although the economic benefit will always flow to the employee. And an alternative to that is just creating a class of non-voting shares. That's a simple solution to that as well. And look, at employees shouldn't think any differently of those. What they're really interested in is the economic benefit flowing from the shares.
Sure. Okay, we have a few questions. Sean, will we go to those?
Yeah, let's go to those.
So we have a question. Is there a way to combine employee shares options so that there are not loads of small shareholders on the cap table? So I think you've answered that, actually. So that is the way, by having a nominee structure. So it's very private, and then you don't have a whole load of small shareholders on the cap table. Would that be the case? Is that the answer 100%. There?
That's good question. That's exactly the answer.
And then from Robin, how easy is it to give non-employees, consultants, etc., share options as opposed to shares themselves?
Easier to give them options than shares.
Easier, okay.
Yeah. Now, unfortunately, when you get into the difference between an unapproved share option plan and a KEEP plan, you can give them unapproved options, but you can't give them KEEP options. And we can kind of dive into the difference there, because there are very specific. Once you have a revenue compliance scheme, there's way less flexibility. But we've devised a plan that combines both the unapproved features and the KEEP features to allow that kind of flexibility. So yes, it can be done within the same plan, but there's slightly different considerations as to who gets what and what the tax treatment will be.
Okay. And then a question, how rare is it that you see the seed investors take some of the hit of the ESOP? Can the founders increase pre-money valuation? Is this always going to be hitting the founders only? So you touched on that also already.
Yeah, no, great question. Very rarely is the answer.
Yeah.
Seed investors invariably push this back onto the founders, but the second part of the question hits at the answer as well. That should force you to fight a little harder on the valuation side as well, in terms of pushing up that valuation. So the investor dilution is less as a result.
Okay. And one from Kieran. If, for example, there are 5 key employees to be awarded in the trading company, not the holding company, and down the line, a separate, unrelated trading business is created, a subsidiary, within which 2 key employees move, how would that be structured? Where we would want to ensure the 3 remaining employees get rewarded within the trading company, but not the second company. And conversely, the 2 transferring employees retaining their trading company award.
Yeah. Complex question. I guess it becomes, I've seen it done, and it becomes very difficult to unwind at a later stage. So ultimately, if you're looking at the exit of the business, how do these various trading entities participate in that exit? Where one will have a certain value ascribed to it, and will have a certain pool of employees driving the profitability of that business, and likewise for the other, and there may not be parity. So you'd really have to, at that point, you really have to value both businesses, and ascribe a proportionate value, and that's how they participate in the ultimate exit. It's pretty messy. I would advise against it. Because when you come to unwind it, it's a difficult issue for an acquirer of a business to, if employees are not dealt with on a kind of a uniform basis, if you like.
And to avoid that even happening, would you be better off issuing shares in the holding company rather than the trading companies? Yeah,
absolutely. We recommend that. For all companies, it's very seldom you would have that kind of disparity. Now, you might have, for example, if you had an Irish parent or holding company and a US trading subsidiary, and you wanted to drive the US side of the business harder and make it more tax efficient, then you might have a separate plan for US employees, that kind of thing. But I would see that more on a jurisdictional basis as opposed to a trading company basis.
Makes sense. Okay, thanks, Sean. You want to
questions
for now?
And then I'm just conscious of time. The how, just to finish off the how. So the types of plan, and there are really 3. There are revenue approved plans like Save As You Earn scheme or approved profit share plans. They generally don't work for 90% of companies because the levels of participation are too low, and the thresholds are too low to make it a genuinely attractive award for employees, and they're time consuming and costly to put in place. And when I mentioned earlier that Ireland was quite a long way behind the likes of the UK and these types of plans, that's what I'm referring to. So these would have been the traditional, and they're more suited to long-standing traditional businesses and not high growth businesses. So I won't spend too much time on those. We invariably do not advise on those, and they're just not suitable for the client base we have, or for for early stage or startup businesses. Revenue compliance schemes are different. You don't have to go through a revenue approval process. It's simply a set of guidelines to follow, and making sure that once you fall within those guidelines, that you'll get a certain tax outcome. And we'll look at the KEEP scheme or the KEEP program in greater detail, because that's what I'm talking about when I say revenue compliant. So you don't need to go to revenue to get pre-approval for this. You adopt it within their guidelines, and if you follow the steps and the rules along the way, you get the right revenue or tax outcome at the end. And then unapproved, there's no disparagement intended with that. It just means it's not vetted by revenue, and that's what we typically see is the revenue kind of unapproved schemes. So I don't know, Rose, if you want to take some more questions, you'll just moved on to part 2.
Yeah, you can go ahead and move on to part 2.
Yeah.
There was just kind of a lingering question on just as a response to that kind of complicated question about the trading company and the holding companies. And the question was, what if there is no holding company? I suppose the answer is that it becomes very complex, which is what you said. But if we didn't, it would be, I'm taking it as a cautionary tale for us if we have the opportunity to now set up a holding company in anticipation of those kind of situations. That would be your advice?
I'd agree with that. Yeah,
yeah.
I think you're talking about in that scenario side-by-side trading companies, and look, you can track. You can certainly have separate plans in each company. No particular issue with that. But when you come to sell, you're either selling both companies, and the buyer will, or you're selling one or the other. And employees here, if you sell, may participate, and employees here won't. But if you sell both of them, then your buyer will have to say, well, look, I'm attributing X value to this business and Y value to that business. It's not unheard of, but it's not optimal, I guess.
Okay. Yeah. Do head into the next part. We have about 15 minutes or so.
Okay. Well, look, I won't do too much of a deep dive here, but just to give some touch points so people are familiar with the language, and I have a follow-up memo that has a bit more detail in it, Rose, that I can share with the participants on this webinar. So look, the most common types of plans that we come across is firstly an unapproved or a vanilla employee share option plan, and that's really just sets out the nuts and bolts of how options work, how they get awarded, how they get exercised, how they lapse when people leave employment or die or get sick, what happens when a company is bought, what happens when a company is restructured or becomes insolvent. And it's really just a set of rules that are a common set of rules for all employees, that says this is, you're being awarded an option over X% in the company, and these are the rules. This is what happens in various scenarios. So you try and capture every possible corporate, personal, or scenario imaginable within that, so that everyone has clarity. So it's not an agreement as such that each employee has to enter into. It's almost akin to an employment policy. Look, here's the rules by which you get granted and awarded options, and how they attract value, invest, and things like that. So that's the basic vanilla scheme. And then the KEEP plan is obviously it was introduced by Revenue in, I think, 2017. And so what this attempts to do is to change the tax outcome when a business is sold. So if I have unapproved share option plans, when a business is sold, I exercise those options. I pay the exercise price, and we'll come back to that in a second. And then I get the sale proceeds, and the balance between, the balance of what I receive is taxed as an income tax event, which is quite penal. Even though it's a great day when a company is sold, when if your options at that point are worth 100 grand and you get a check for 50, there's slight disappointment there once the tax impact becomes known. So what the KEEP plan tries to do is say, okay, within these parameters, these options will actually get a capital gains tax outcome. So instead of paying 50 cents or 50 cents on the euro, you'll pay 33 cents on the euro. So they're trying to make it more attractive. It could be infinitely more attractive than that. But that's really what they're trying to reward, which is to shift it from an income tax outcome to a capital gains tax outcome, which it would be, for example, for the founders who have shares right from the start. They always get a capital gains tax outcome, and there are incentives for things like entrepreneurial relief, where the first million of proceeds to a founder would attract a 10% capital gains tax. So you can see they're trying to move in the right direction. It's just very, very slow, and unfortunately, a lot of what you see is tax driven here. And if I just give an example at this point, if you had a very key hire that you wanted to employ, and you said, look, we've got a vanilla share option plan and you've got 5% of that, then he or she may do a calculation and say, well, actually that's net to me on an exit of the business, this is only worth 2.5%. But if the company had a keep plan, they'd look at it differently and say, well, actually the net to me, this is worth 3.33% after tax. So that can help move the dial as well when you think about those types of considerations.
Okay.
The next two are really share plans, and this is where companies have grown in value, but you've got a particularly key hire or key employee that you want to reward with a significant amount and do it in a tax efficient manner. And I'll get into some of the detail of this, but what you're effectively saying is, in the restricted share plan, is we're going to put so many restrictions on these shares that their value is depressed, and then you'll pay that market value and own the shares. And so when the company's sold, there'll always be a capital gains tax outcome. Okay. And the growth share plan says, in a nutshell, says, well, look, if the business is worth €5 million now, we're going to create a class of share that you will own from day one that participates in all proceeds over 5 million. So you're only participating in the growth above current market valuation. And that's becoming a more and more common tool to put in place for late joiners to a business where there's a lot of value already built up.
Okay, so you kind of start where we are right now and you put a cap on how we've grown to so far, and say everything above that you'll be rewarded for. Exactly.
And for really high growth companies, that can be quite attractive.
Yeah.
Okay. Just to give some flavor for the unapproved ESOP. So when I say unapproved ESOP, the keep plan just layers on some extra bells and whistles. So you can think of them in the same way, but keep has some extra restrictions. So normally these are used with employees across the board, and you just make the allocations depending on seniority or value to the business. It can be used for targeted key hires, as we mentioned. We talked about the framework document, which is the set of rules or the policy that's adopted by the company, and then an option certificate is given to the employee, and that's really the mechanics of that. It's pretty straightforward. Typically, they have to be exercised within 7 years. Otherwise, and the reason for that is a tax-driven reason. Longer than 7 years, they'll attract an income tax charge at the start. And what you want to avoid here is employees having to pay tax at any point before they get value.
Yes, okay. Of course, yeah.
And as I said, for those very reasons, they typically only get exercised on an exit event. Although sometimes you may have an employee who leaves in good circumstance and say, you'll want them to retain their shares, and they may wish to exercise at that point. But there will typically be an exercise price attached, and that'll be dependent on the value of the business at the time the option is granted. So for a very early stage company, if your valuation was $500,000, you would attach an exercise price of $500,000. But as things progress, that valuation will go up and the exercise price will be higher. I think we've talked about the vesting criteria. typically over a 3 to 4 year period, with what they call a 12-month cliff, which is, you have to get past that 12-month period before anything starts vesting. And finally, it's not just time vesting. You can attach performance vesting. So if you had some really key hires who you wanted to, for example, a key finance hire, you might say, well, look, you need to close a financing round and then your options will vest then, as opposed to over a 3 to 4 year period. So they can be used with milestones instead of time-based vesting. So jumping into KEEP, I think we've covered a lot of the general kind of criteria here and the rationale for doing it, but there's very specific criteria that obviously, look, we can guide businesses on, but just broadly, most businesses will qualify for this, but there are certain activities that won't. Financial activities, professional services, property, those kind of things. So it's really aimed at not specifically at the tech sector, but really with that in mind to help drive innovation. The market value ceiling here is €3 million, and that, for a company that has a really high trajectory and growth pattern, that's one of the problems of KEEP, which is, you very quickly hit that ceiling, and so you lose all the tax effectiveness beyond that ceiling. And there are annual filing requirements and things like that, but nothing too onerous. I think it's important to look at the employee criteria as well. So it's got to be a full-time employee or director working more than 30 hours a week. So you can see, once revenue get involved here, it's very prescriptive as to the criteria that need to be employed. And then the total market value, or TMV, is very prescriptive as well. Can't be more than 100 grand in any tax year, or 300 grand. And again, if you've got a company on a trajectory like this, and that ceiling can be easily exceeded by certainly senior people in the organization. And again, the share, it's again an option over. It must be an option over ordinary shares, or we could have non-voting ordinary shares. It cannot be, and this is critical as well, it can't be granted at less than market value. And that can be quite an impediment as well. So later joiners will have less benefit, because they'll have to pay an exercise price at the time of sale, which is pegged to the value of the business at the date they got their options. So early option holders get more value, et cetera, et cetera. Sure. And then the restricted share plan, again, I won't labor this one particularly. It's more for later stage companies, but it's a way to kind of get into the equity by paying a small amount for shares on a depressed valuation basis. And that's a useful tool. A lot of detail around that, but but particularly for later stage businesses, if they've got key people they want to reward who understand the tax impact of options versus shares, etc., that can often be a useful tool. And again, the growth share gave you the general nuts and bolts of this, but again, it is rewarding employees for growth beyond a certain point. So employees will pay a very, very small amount to get the shares into their hands, and they'll participate in the growth of the business going forward. And I suppose the last thing to say, and achieve a CGT outcome, which is the key, and not to labour the tax points too hard. The one thing I'd say with the share plans versus the option plans is be very, very careful when issuing shares to employees. So do it through a nominee company. Always have an agreement with employees that if they leave the business, they'll surrender the shares back, or surrender the voting rights back, or however it's structured. But again, just making sure that there's
nothing lingering there.
Nothing lingering. Yeah. No ex-employees that might, you'd be amazed the number of times a former employee or a former shareholder shows up when there's a sale on the cards. So just be very careful of that one.
Sure.
Uh,
Sorry, Sean, just a question about the growth share plan. Sorry, buzzer is going here. With the growth share plan, do you have to revalue annually, or is it a one-time creation of a share pool at current value?
Every time you award them, and a lot of companies do it on an annual basis, you'd have to have a valuation. But what I'd say is start with a valuation metric on day one. That's it might be whatever's an industry multiple, 7 times, 8 times revenue, or whatever it might be, and then just apply that consistently. So you don't have to go back to a third-party advisor or accountant to do that valuation exercise. Get it done once and apply the same metrics consistently, and that should be fine.
So you don't have to do it annually?
No.
Okay, and then another question on the growth share plan. Is it common that an early stage company will start with an ESOP and then move to a growth share plan over time? Sounds like that's likely, would it be?
Yeah, more and more so. Because once value is built up, it's very difficult to make those later awards tax effective. So this helps with that. Now, I mean, for new joiners particularly, I think it's useful. I mean, what you're saying is, well, you haven't been involved in building the growth of the business to date, so you'll be rewarded for the growth going forward. And that's an easy concept for employees to digest.
Just another question here. Regarding the valuation, can it be determined from EBITDA and then annually applied?
Yeah, it can. What we'd suggest is the first time this is done, that you get some kind of external validation from your accountants or your auditors, just to ensure that. I mean, this is all about creating ultimately a track record for revenue to inspect, to make sure you followed the rules. So, it would always be documented in board minutes, and it's much more helpful to have external validation of that rather than a director's or founder's best estimate. And it doesn't have to be like an expensive valuation exercise, but just something that shows an element of independence that's driven your view.
Very good, thank you.
Okay, well, I suppose we've laboured the tax treatments. I think everyone will understand how important it is, and a lot of this is unfortunately driven by tax, but that's where we are. I think the implementation, just to finish off, it's variable depending on the plan. The option side of things is fairly prescriptive in terms of a plan document and set of rules, and then layering, if you want to have a keep plan, layering that the criteria on that. We've developed a product that combines both now, and works within Ireland and on for kind of non-keep options, if you want to call them those, for international employees as well. Normally, you'll have to adjust the company constitution to create different share classes and make sure you've dealt with or deal with the shares or options held by employees within that as well. And that's really just a safety net to say that how they get issued, how they get transferred. Generally, they're personal and won't be transferable. And then what happens on a sale. So just to kind of lock that down. And then finally, costs, depending on the plan, but I would say budget for 2.5 to 3.5 grand to implement something like this. So that, often that goes into your timing if you're, prioritizing spend as well.
Okay, thank you very much, Sean. I know we're getting some notes of appreciation here for the valuable information you've provided this morning. One last question before you go is, what typically happens to options if their holders leave the business before a sale?
They typically lapse.
Yeah.
There'll be a win. Sometimes, depending on the circumstances which an employee leaves, they may be allowed to keep them and exercise them. But for example, under the keep plan, there's a 90-day window to exercise or lose. So generally they'll lapse and you won't get to participate. And that's part of the game in terms of incentivization and retention, I guess.
Yes. Okay. And you had that holding not a holding company, but that nominee structure where they kind of can, I take it, those options move in and out of that nominee structure.
Exactly. Now,
Yeah.
with an option plan, you'll find 99 times out of 100 options are never exercised until the exit point. And so you may not need that nominee structure, or you may use it at the exit point to make the sale process a lot easier, dealing with one nominee company as opposed to 100 employees, for example.
Okay. Sean, thank you so much. Do you have your contact details there? We can put up, or we can send out an email anyway.
Yeah, I'll follow up with a memo on this, which has a little bit more of the detail, and I'll put the contact details on that, and people are welcome to get in touch.
Did you say you have? Did you say you have a little kind of video? Is that what you
No,
mentioned
it's
earlier?
a 2 or 3 page memo.
Memo. Yeah, great. Yeah. Do that. And we will also send out the video of this, and we'll create an article with the content that you've explained to us today. So thank you from all the participants, and thank you to the participants for your great questions. And Sean, we're going to see you again soon, aren't we? We've got another webinar from you in the offing with some follow-up kind of related topics. So we'll let all of the subscribers know about that too.
Yeah, well, if not me, one of my colleagues will talk about kind of early stage investments, term sheets, do's and don'ts, and how to deal with investors. So hopefully that'll be of interest to the wider group as well.
Definitely, yeah, that would be fantastic. Okay, everybody have a great weekend, and we'll see you back here soon. Thanks, Sean.
Thanks, Rose.